Welcome to another Coffee with Samso, where we speak with ASX companies and the guys who run these companies and hear what they say. We're here at the University Club in Crawley on the University of Western Australia campus. And I've got New World Resources Limited here with us today. ASX code is NWC. Mike Haynes is here. He's the Managing Director and CEO. At the moment, as we speak, the market cap's 62.96 million. New World Resources is all about the Antler Copper project in Arizona, in the USA. And where 70% of all copper that comes out of the US is from that region. We've looked at this region before previously. There's just clusters of these VMS styles projects all over the place. Mike, welcome back. It was about just over 12 months since we last spoke. Look, I love the story. Maybe you can give us a recap of Antler and New World, where you guys are, and then let's hear the good stuff that's come about.
Thanks, Noel. Yeah, look, great to be back. We probably should have been here a little sooner because we've had a lot going on in the last 12 months. Maybe if I step right back to the beginning of the story, the involvement in Antler really came about almost 4 years ago now. And deliberately, corporately, our company New World set about finding a high-grade copper deposit that we could bring into production in the second half of this decade, because even 4 years ago, we anticipated that copper prices were going to be a lot higher in the second half of this decade than they were 4 years ago. So we deliberately sought out a high-grade deposit, and because we wanted grade, we deliberately searched for VMS deposits, and we had an operating team in the US, and corporately we're based in Australia, so we searched those two jurisdictions. Very quickly, we acquired a project down in New Mexico, a VMS project, and a couple of months later, we secured the Antler Copper project. And that was, I first visited Antler in December 2019, and I've got to admit, since then, every step along the way, which is a real rarity in this business, but every step along the way, the Antler project has exceeded expectations. And for the last 3 years, it's continued to exceed expectations.
I think what you just said there, when I'm reading through, obviously, it's been 12 months since I looked at your stuff and followed you, bits and pieces. It is very, 2021 was when you basically announced that you got this thing, I think, if I'm correct.
2020, March 2020. Yep.
And between then and now, you've increased the resource by 50% from your previous resource. It's done a lot, and it seems to be always giving. VMS has that history of continuous giving up, So is that what you're seeing now? You're feeling, obviously, you've done all that work, right?
Yeah, look, when we acquired the project, so Antler it is a historic producer. It was in production most recently in 1970, so 52 years ago. There was small-scale production from Antler. And at the time, copper price was 45 cents a pound, and at the production rates that they were mining at, it wasn't economic to mine it. So they shut down operations and mining never resumed at Antler. Now, when we acquired the asset, we knew that there was a deposit there. It was extremely high grade. It was roughly 3%. Historic production was roughly 3% copper and 6% zinc, or we refer to it as 5% copper equivalent, just for simplicity, rather than having to talk about copper and lead and zinc and gold and silver credits. We simplify that down into copper equivalent. So the historic grade was around 5% copper equivalent. At the time, there had been some very deep drill holes, very widely spaced, and some very widely spaced holes drilled along strike that suggested to us that maybe there was 5 million tonnes or thereabouts of mineralisation. There was indicators that there might have been 5 million tonnes. So in March 2020, we secured the rights to the project and we started drilling. And by November 2021, so 18 months later, we'd put together a JORC resource of 7.7 million tonnes. So basically 50% greater than our initial expectations. And the grade of that resource was 3.9% copper equivalent. But at the time, we'd only drilled to 500 metres depth. So historic working had been down to 150 metres depth. We drilled underneath that and progressively, over 18 months, drilled down deeper down to 500 metres depth. And we've continued to intersect exceptionally thick, exceptionally high-grade mineralisation. Now, we continue to drill, but equally we use that 7.7 million tonne resource to start thinking about, well, what can we mine here? We've completed an economic study, a scoping study, to determine what sort of rate we can mine at and what sort of capital cost it would take, what sort of operating costs we might be looking at, and what sort of production profile we might be looking at over what time frame. So we've completed that on the back of the 7.7 million tonne resource. But while we've been doing that scoping study, we've continued to drill deeper and deeper, and we've now drilled down to 850, 900 metres depth, and still the mineralisation's there. This is just in this one deposit alone. So as you ask about VMS deposits, this VMS deposit is now clearly at least 900 metres deep. The biggest ones in the world can go down 3 kilometres depth. So maybe we can go another kilometre. Maybe we can go another 2 kilometres. Who knows? But if we do, the resource is going to get bigger and bigger and bigger. But equally, these VMS deposits, almost always around the world, where there's one, there's another one. And often where there's two, there's a third one. So just in the last 3 months, we've started looking along strike because we've got a lot of look-alike geochemical and geophysical anomalies that indicate to us, well, maybe there's 2 or 3 just in our land holding alone. We know there's another one 6 kilometres away that is outside of our land holding. It's just a small one that's owned by a private group of individuals. So we know there's 2, and where there's 2, there may well be 3.
Oh, I think that's when you go deep, are you seeing the geology getting better, different, the same, grades getting better, or the hang better? Are you seeing any kind of that stuff?
What we have seen, even when we declared that maiden resource in November 2021, so just on 12 months ago, at that point, as we were getting down just below 300 metres depth, we started hitting some ultra-thick mineralisation. When I say ultra-thick, there's zones in this, what we call a main shoot. So we call it a shoot because it's a thicker zone of mineralisation. There's zones in this main shoot that intersect up to 42 metres thick. So as we've gone deeper and deeper, so once we got about 300 metres below surface, we got into this extremely thick mineralisation. We've now drilled this extremely thick mineralisation down to 900 metres below surface, and the deepest hole in that is still 21 metres at 5.5% copper equivalent. So the thickness has improved once we got to 300, but it continues to be good. Equally, we've got another parallel shoot that we call the south shoot, that again is a thicker zone of exceptionally high-grade mineralisation. And as we're drilling deeper and deeper in that one, the best result from the project yet has been 27 metres at 7% copper equivalent. And then just early this week, we announced the deepest hole in that south shoot that was 10.7 metres at an extraordinarily high grade of 13.7% copper equivalent. So it seems that the thickness as we go deeper and deeper is continuing, and we can't be definitive about it, but it seems that the grade as we go deeper and deeper may be getting better and better. But the grade's always high anyway. The grade is it's everywhere we hit mineralisation, it's high grade. So whether we hit half a metre or whether we hit 5 metres, it's always a minimum of 2% copper equivalent, and typically it's 3, 4, 5% copper equivalent.
For the guys out there, you're a geo, you walk out there and you drill a hole and you're looking for something similar to this, not knowing that you may have something like an antler. What's a number that you go, hey, that's really good, boys? Is it in that 2 3s or is it 1s, or to just give an idea of how good the numbers are? I know that it's good numbers, but what would most people be happy with?
I would say most VMSs would grade somewhere between probably 1.5% and 2.5% copper or copper equivalent.
Yeah.
Well, copper equivalent. So the fact that ours is consistently grading 3.9, 4, 4.1, and we haven't yet mentioned it, but just last week we updated our resource base. And the resource base is now 11.4 million tonnes at 4.1% copper equivalent. So we've increased the resource base by almost 50% over the last 12 months by drilling deeper and deeper, and the grade has come up marginally. But whether it's 3.9 or 4.1, it's still extraordinarily high grade.
Yeah.
So globally, these VMSs can be very high, but interestingly, there's an analyst at Canaccord, a guy called Paul Howard, who was actually on site several months ago, and he has a database of 830 copper deposits around the world, and he regards Antler as the 30th highest grade copper deposit on a copper equivalent basis out of that entire database. So this is an ultra high grade deposit. Now with that, Noel, I'm sorry to continue, but with that means that if copper price is low, our operating cost is very low. So even if copper price is low, we should make money.
Yeah, I mean, we can touch on that a bit further because there's the fact that it's copper equivalent, there's a connotation in there. There's a thought that that means that you're getting your copper out for free, and the rest is credits, right? Which make your capex or cost of production almost in the negative world, which you've mentioned. But from an investor point of view, because investor expectations are very demanding, as I'm pretty sure you know. They look at this, they go, great, looks fantastic. Tons, yeah, great, fantastic, and all this. What's the problem? Because obviously they're fixated on the share price. We all know that. That's simple fact. So, and they're saying, well, when are we going to mine? But bear in mind that mines don't happen in months or years, multiple years, right? So how do you talk to these guys out there and say, look, he's asking, what's the problem? Why's my share price dropping or whatever?
So I think incorrectly so, there's somewhat of a perception in the Australian marketplace that you can't mine in Arizona. Now, that is so far from the truth, then it's almost laughable that there is this perception. But I think if the Antler deposit was sitting out the back of Meekatharra or out at the back of Kalgoorlie, then our market cap would be 5, 10, maybe 15 times where it currently is. But seems to be a somewhat of a perception that mining in Arizona can't happen. Now, you introduced this by saying 70% of copper that's mined in the US is actually mined in the state of Arizona. So categorically, you can mine copper in Arizona. Not only that, where we are in Arizona, we are on privately owned land, sparsely populated, and in an area that is not particularly environmentally sensitive, and we are looking to implement an underground only mine that's not at all intrusive, returning 50% of our waste product back underground as paste fill, so a very small surface footprint, all within an area, a jurisdiction that is pro-mining. Indeed, northern Arizona, where we are, is exceptionally pro-mining. So we are extremely confident we can take this into production very, very quickly, and we are taking this into production very quickly. But I think the Australian audience hasn't quite appreciated that Arizona, and northern Arizona in particular, is a pro-mining jurisdiction. Coupled with that, if I can add, I think somewhat our share price does correlate somewhat with the copper price. So as copper price moves up, then we do see somewhat of a correlation with our share price, and as copper price does come down, then our share price moves somewhat with that as well. But I would say, given that we've now got 11.5 million tonnes of exceptionally high-grade mineralisation that is not dependent on the copper price for profitability, then we should be outperforming that copper price.
That's a good thing, though, because I think I think a lot of people I speak to, the copper price is going north now. At what steepness and things, it's up, it's unknown, but the chance of it going forward and rising is much greater than, say, 6 months ago. And that, if that was correct, then that's a good thing for you guys, if that was following. Looking at your long section on page 7 of your presentation, if you remember, hopefully you can. I can see that the grade variation is huge, right? And you've highlighted where you got the good grades. And is there an issue how you guys, I know it's a good issue, how you're going to put that all together, extreme high grades and not so high grades, and the grade variation issue for you, for mining engineers. Is that something that is of concern or a problem, or making you guys think harder, making it longer to make decisions?
No, look, so I'm not sure if you're referring to the updated resource.
Yep.
That shows the grade distribution, or the coloured where we have magenta zones, red zones, yellow zones that show grade thickness. Now, I would say that across the deposit, without exception, grade is very, very high. So maybe the section that you're referring to shows some ultra high grade. So on our most recent long section that accompanied the updated resource, then you'll see some reds and some magentas. Now, some of those grades are 5-6% copper equivalent, but the surrounding material is still running 3% copper equivalent. So overall, when we mine these stopes consistently, we will be mining 3.5-4% copper equivalent ore. So in terms of delivering that to the processing plant, we won't need any particular unusual mechanisms to tweak the plant according to grade. The grade will consistently be high.
Let's move on to the scoping study numbers. Your market cap 62 million, and I'm looking at the numbers and I'm thinking, first thing I look at is typical Chinaman. How much is it going to cost me, right? So your capex is 201 million, correct? And within that's a 36 million contingency, is that correct?
Correct.
So effectively 164 million is your capex. 160 million plus. That's not a lot of money for what we're talking about here, right? Because you've
not for the returns that the project
is my point.
So the payback will be exceptionally quick, because not as soon as, but shortly after we're in production, we are generating extremely good cash flow. Cash flow in our scoping study, once we're at steady state production of 1 million tonnes per annum, on average, annual cash flow is $135 million a year. So for capex, as you say, 200 million or maybe 165 million if you take out the contingency. If it's 200 million and you're making 135 million a year, payback is a year and a half.
I know I mean, when I look at that, my question is, why are we, where you are at 62 million, call it 63 million, right? I mean, and my question is, question should be, how good is Antler, or what is the issue with Antler in terms of that mining, looking at numbers and stuff?
Yeah, I think particularly over the last 6 to 12 months, we've probably been caught up in global concerns about inflation. And we saw probably from December, January this year, then the investment community started getting a little bit more cautious. And with that, the copper price started coming off as well, because the view for economic development globally was somewhat muted. As that happened, our share price started coming off, and as that started happening, then some of the institutions that we had on our register started selling out, particularly in the lead up to June 30, where I guess they were rebalancing their portfolios, and arguably some of them needed to go to cash under their investment mandates, and rightly or wrongly they elected to sell down out of New World. And we stabilised at that point at about 3.2 cents, and around about that level we've traded pretty stationary on our chart, around 3.2 up to maybe over the last couple of weeks we've got up as high as 4.5 cents, but we have been pretty stable around that 3.2 cent mark. Now, I think as concerns about inflation are starting to become a lot more subdued, I think there's acknowledgement that the interest rate rises are starting to have effect, and inflation may not be as big an issue, or maybe it's been brought into check. And with that, I think there's a view that economic development is about to start again, and we're seeing the producers, the copper producers, firstly BHP has made a bid for Oz Minerals. So that's indicative that BHP is taking a long-term view on copper. We've seen Sandfire, who's probably Australia's next biggest copper producer, their share price is going up. 29 Metals, who's another Australian producer, probably not quite as big as Sandfire, their share price is going up. But the emerging producers like New World, and we can put KGL, Eagle Mountain, Staveley, Hillgrove in that basket, Peel Mining, PEX, then the emerging producers, if you look at our charts, then we're still all pretty stationary. So I think we're yet to move. But I think it's only a matter of days or months before we do, because the world is identifying this demand for copper. And so the initial focus is on the producers, and subsequently it'll filter down to the emerging producers. And in my situation, I think we've got a compelling case where we have the highest grade on the ASX, we're closest to production, we're in a fantastic jurisdiction, and I anticipate that we will move in advance of everyone else, and we will outperform everyone else in our peer group.
Some of the names that you mentioned, I think you guys are way above in terms of the next cap of the companies to go into production. I'm looking at your numbers and stuff. It doesn't make sense for you guys to be where you are. For me, in your presentation, you talk about you got high grades, you got lateral continuity and vertical continuity, which really is sort of where I was trying to get at with the previous question about grade variation, because to me you're obviously not having a problem trying to get your grades together, your numbers together, because everything seems to be, I've heard of many projects where it's really hard to get that, and and when they come to modelling it, it's they're trying to model little tight things to get the numbers, but it seems that you're pretty okay on that front, right?
Well, at present, and we've only drilled to this point in the last 2.5, 3 years, we've only drilled over a strike distance of 600 metres. That's it. And the reason we've done that is because almost every single hole over that 600 metres has intersected massive sulphide mineralisation. And as we go deeper and deeper, we hit more and arguably better mineralisation. So to this point, all we've modelled, all we've intersected is one continuous ore deposit. Now, when we look at how much of that is mineable, in November 2021, so 12 months ago, that 7.7 million tonne resource that we declared, 95% of that can be mined according to the mine design that we incorporated into our scoping study. That's an extraordinarily high conversion rate. We're calling it a mineable inventory at this point, as opposed to a reserve, but it's only a matter of time before we declare a maiden reserve. Now, normally you'd expect a resource to reserve conversion of maybe 50, 60, a good one would typically be 70%. In our case, we believe 95% of that resource can be mined, and that means that as we now do an updated mine design and a mine schedule on the new resource, which is now 11.4 million tonnes, we expect, again, it's one continuous deposit, we expect conversion there to be very, very high as well. So if we can mine 95% of that 11.4 million tonnes, we can now mine 11 million tonnes of mineralisation. There'll be a bit of dilution. Let's add another couple of million tonnes of dilution in there. All of a sudden we can now mine 13, maybe 13.5 million tonnes will be delivered to the mill over probably a 10-year mine life. So our production profile is likely to be 1.2, 1.3, 1.4 million tonnes per annum over 10, 11, 12 years, instead of the scoping study that was looking at 9.3 million tonnes mined over 9.5, 10 years. So we'll probably be producing 20 to 40% more metal every year over a longer timeline, and with a larger production profile, operating costs will come down. So what are already extremely robust economics will just look better and better and better because we have a bigger deposit.
Mate, a Chinaman would have mined this already. That's for sure. Look, looking at the flow sheet, I'm looking at all these recovery rates and things like that. Any sort of potential hiccups there, you know? Or is it you're going to get better numbers, or it will get worse? I mean, what's...
You touched on this earlier, Noel, and one of the tricks with these VMSs is, and Antler's one such situation where we have valuable copper in the deposit, we have valuable zinc in the deposit, we have valuable lead, silver and gold. So rather than just maximising our recovery of copper, what we need to do is find a way to maximise recovery of all of those payable metals. So I refer to it as maximising payability. So with our metallurgical test work, then we have achieved results where we get 95, 96% recoveries of copper. But when we do so, that might come at the expense of only getting 60, 65% of the zinc. Now, when Antler was last mined in 1970, they were getting high 80s for copper recoveries and high 80s for zinc recoveries. About 51% of the value is in the copper, and about 40% of the value is in the zinc. So in order to maximise payability, we want to be getting good recoveries of copper and good recoveries of zinc, as opposed to ultra-high copper recoveries and modest zinc recoveries. And so our metallurgical test work and historic work is indicating that the high 80s for copper and high 80s for zinc is where this project is likely to end up on a metallurgical front. And we're comfortable with that. We're factoring in those recoveries into our economic studies, and that's not atypical for VMS deposits.
And you know, cost of production, you're talking about $1.66 a pound US, and if that's copper equivalent, or if not, you copper only net of the co-products is negative 31 cents a pound. I mean, those are very compelling numbers, right? It's almost like you're not affected by the variable copper price. How? I mean, obviously this is the early stage of trying to get the numbers right. How much movement is there in there? Are we going to see like a big error? What's the plus or minus on that kind of stuff?
So in terms of the scoping study, we were assessing on a very informed basis using US consultants. We were assessing what the operating cost may be. Now, we were looking at a production profile of 1 million tonnes per annum for that. And as you say, on a copper equivalent basis, we see that we would average production of about 30,000 tonnes of copper equivalent metal a year. And that would comprise roughly 15,000 tonnes of copper metal and roughly 38,000 tonnes of zinc metal, and a little bit of lead, a little bit of silver and a little bit of gold. Now, under that scenario, then the zinc production itself pays for the operation. Now, we were using a zinc price of $2,800 per tonne. So assuming zinc price, and today it's closer to 3,100, so there's 12% variation there on the upside for us. But assuming zinc price is $2,800 a tonne or better, it means we would be producing 15,000 tonnes of copper metal each year at nil cost, well, better than nil cost, at negative cost, because the zinc production pays for the copper. Now, how confident are we on those operating costs? Costs have changed. Costs have gone up with inflation, with wage growth. We have factored all that into our studies. Precisely where wage bill will be when we come into production in 2-3 years' time, then it may be higher, it may be lower. But regardless, the project is not sensitive to that operating cost because the zinc pays for that operating cost. The copper comes for free. Now, if we can be producing at 1.3 million tonnes per annum instead of 1 million tonnes per annum, then the operating costs that we've predicted, which I think is around $112 per tonne, that will come down marginally because we'll get economies of scale. Administration costs will be spread over 1.3 million tonnes instead of over 1 million tonnes per annum. we'll get some efficiencies in mining rates, we'll get some efficiencies in purchasing power, just because we're operating a larger rate. So that $112 a tonne is likely to come down a little bit, depending on wages, of course. But in terms of total operating costs, if everything's equal, it is cheaper to operate at 1.3 million tonnes per annum than it is 1 million tonnes per annum. So we aren't at all concerned about our operating costs.
I mean, I've talked to a lot of people in Coffee and Samso and a wide range of projects and companies and stages. I mean, you guys, New World and Antler, it sticks out, in my mind of most likely this is going to happen. When you talk to the guys that have influence with the funding and the money and all this, and what are they sort of telling you, and what are the rumours or gossips talking about Antler and where you guys can go? Because are you concerned about future funding? I mean, as we said, 200 million is really not that much for a project like this. What are you hearing?
No, look, in terms of developing the project, currently with our market cap of about $65 million, if we needed today, if we needed the 200 million, then that might be a slight stretch. But today we don't need that 200 million. Now, I've started talking to debt advisors, and the debt advisors indicate that just on the parameters of our scoping study, which is based on that small resource, the 7.7 million tonne resource, not the 11.5 million tonne resource, just on that alone, because the economics are so robust, then they indicate that easily we'll get 60%, maybe as much as 65% debt. And not only will we attract debt, but because of the robust economics, that debt will be on quite favourable terms. So you can get good debt and you can get bad debt. We don't want bad debt, because bad debt actually leads you down a rabbit hole where it might send you broke. So we'd only want to attract debt if we can get debt on good terms. Now, if we can fund 65% of the project, let's call it 130 million US with debt, that leads us 70 million US to find. Let's call it 100 million Aussie. We don't need that money today. We will need that money in 18, 24, 30 months' time, once we've taken this project through pre-fees, definitive fees, and we have permits and we're commencing construction. Through that period, we will illustrate that even more robust economics. We'll fine-tune that with a larger resource, initially with a scoping study update, then with the pre-fees, then with the definitive fees. So we're de-risking the project from a technical and from a funding perspective. As we go through that process, if we aren't re-rated as an emerging producer with an exceptionally robust resource and an exceptionally robust reserve, then I probably won't be sitting here, Noel, because I won't have done my job right. The economics of this project are so robust that I am exceptionally confident that over the next 2 years we will be re-rated as we move into production, and as we go through that period, if copper price is even higher than it is today, then we will see a dramatic re-rate. We saw our share price about 18 months ago jump from 5 cents to 10 cents in the space of a month. And that was as copper price started taking off. Now, we were actually surprised that the copper price took off when it did. We thought copper price would probably gradually rise a little bit more gradually, and probably over a longer time period. And my honest belief is we're in that phase now. I think we're in that long ramp up where we're going to see copper price jump. Today we're 8,400. Last cycle, 18 months ago, we saw it jump up to $10,500 a tonne. I wouldn't see it be at all surprised to see it at 10,500, then 11,000, then 12,000 a tonne over the next few years. And as that happens, with us being a near-term producer with exceptionally high grades, with exceptionally good margins, I am exceptionally confident we will be re-rated, and that will mean finding that 100 million Aussie in equity to finance the non-debt component of the project should be a lot easier.
Oh, I don't think I disagree. I think your project almost speaks for itself, and we all know the market's going to move. You don't take a genius to realise the market's going to turn anyway. So, look, going forward, what are the eager beaver investors out there going to be hearing from you guys? What's the news flow?
Okay, I still see there's two real value drivers for New World. At present, our resource base is at Antler alone is completely constrained by lack of drilling. So the three deepest holes on the project, 21 at 5.5, 27 at 7% copper equivalent, and 10.7 at 13.7 copper equivalent. They're three of the probably 5 deepest holes on the project. We just haven't drilled deeper. So there's more mineralisation under that. So I repeatedly say the two value drivers for us are to increase the resource base. With a bigger resource base, you can have a higher production profile. And with a higher production profile, you reduce your costs, produce more metal, generate more revenue. So bigger resource base equals better NPV on the project. But equally, if we are in production, then we will be even more valuable. Just like I said, Sandfire's in production, 29 Metals is in production, Oz Minerals has been in production. The producers command a premium. So we are pushing Antler to production so that our share price commands a premium just like the others.
Fantastic. Mike, what a better way to end. I think, I think Antler is one of those ones that I don't think there's, or in my 100 plus videos here, we haven't really seen one. I mean, of the caliber, I think. But as you say, time will tell. Look, Mike, we teamed up with Florence Drummond to give away a coffee to our guests, and this is from them. They have a group called Kick, a group of companies that self-employed people and businesses that can support our industry. But look, Mike, any last words to the guys out there to say, buy my shares?
Yeah, look, Noel, probably one thing I don't think we touched on is where there's one VMS in a belt, there's often two. And we know there's another little one called Copper World that's privately owned. But a long strike from us, and we are about to embark upon some first drilling outside that 600 metre long corridor. We're about to embark upon drilling some look-alike antlers, coincident soil anomalies and coincident IP geophysical anomalies. Drilling is about to commence on there, and I think the whole combination of what we have is pretty exciting for your investor group. So I appreciate the opportunity to come here and update you on where we stand.
Look, I think everyone needs to understand VMSs, right? They as you said, they occur in clusters, and they seem to get better as the people are working on it. Golden Grove is a classic example. It's gone from someone about to shut shop, and now it's flying, with colours. So thanks, Mike, and I hope we continue to get you updates and talk then.
Excellent. Thanks very much, Tom.